And today's week jobs report, with payrolls climbing just 142,000 in August, was below expectations of 161,000. That said, the unemployment rate actually fell, but the Fed is still expected to cut rates in less than 2 weeks. The question for investors now is by how much, with odds almost equally split for a 25 versus 50 basis point cut. And Fed Governor and voting member Waller says he's open to a bigger one. Joining me now, Diane Swonk is chief economist at KPMG. Here on set with me, Steve Sosnick is chief strategist at Interactive Brokers, and of course, our own Steve Liesman is here. Welcome to all of you. Steve Liesman, not to gloss over the jobs report, but what Waller said really has taken the markets by storm.
To an extent, the market's been kind of all over the place today, and I think it reflects the mixed nature of this report today. I think a look at the intraday on the 2-year is a really good example of what's going on or what isn't going on. If you take a look, what you see is the market push yields higher, push them lower, push them higher, push them lower. That chart, if you go back, actually, folks, a little bit more than that. I'm sorry. If you could go back a little earlier in the morning, you can see the reaction to, there it is, that spike right there on the 2-year. Then it came back down, real seesaw, within a certain range there. And I think the story is that we know for sure, given the interview we did with Goolsby as well, there are people who want to do more from a longer term or strategic basis, but tactically they may not be able to pull it off. I'm not sure we have enough data between now and the 17th. If the default case was 25, you have a retail sales report that morning of the meeting. I'm not sure there's enough data. Maybe the jobless claims can, if they start to crank up. Well,
that's, Diane, what's so interesting is the jobless claims have been fine. We saw this morning the unemployment rate actually fell. And I mean, we all know it can wiggle around and still be on an upward trend, but maybe it's significant. There have been some economists making the case that we're just trying to absorb all the new entrants in the labor market, but it's not otherwise acting as a labor market that is breaking down.
It's not breaking down, but it is skating awfully close on thin ice. And I think that's the part that Jay Powell is most concerned about. He sees the window for his legacy here on nailing a soft landing as narrowing as we move into the fourth quarter, given the pace of hiring that we saw in the JOLTS data as well this week is more consistent with a recession or much higher unemployment rates than what we've seen. Now, we don't know any rules of thumb. We know we've breached the SOM rule. We know Claudia herself has said rules are meant to be broken. But there is weakening in the labor market. When you look at the 3-month moving average on job gains at 116,000, that's within the range of not different from zero in terms of significance. And I think those are the issues when you also look at the big three that have been driving job gains: state and local government, leisure and hospitality, and healthcare and social assistance. Those three sectors also had major losses in the number of job openings at the end of July. And so that begs the question is, what is going to be the momentum going forward, given that the relay race that have been going on with the least interest rate sensitive sectors carrying employment? Is there a risk that we now see a bigger pinch in employment as we go into the fourth quarter? That is the risk. The Fed, it's a heavy lift to get to 50 basis points. I agree with Steve. I think it's going to be a weak retail sales report, just given the vehicle sales alone. But also, I think there's some broader weakness out there. It's a heavy lift to get to 50 basis points, but I think we're still at 1% in cuts by the end of this year. And September, I think Powell would like to see 50. The question is whether or not you can corral the cats to get behind him.
Sure. No, in 12 days is not a lot of time at this point. Steve Sosnick, how are you thinking about this and what it means for the market?
Well, first of all, I do think that we're closer to full employment than not, which is in fact, Powell reminded us about the dual mandate. And by the way, in here, we didn't get a very happy pricing portion of the dual mandate because monthly average earnings actually rose a bit more than expected. So that's not all that friendly. I think what happens now is it's very difficult for markets to figure out what's going on. As you pointed out, Steve, with the two-year yields bouncing all over the place. They were down 9 basis points. They were flat. They're down 5. When you can't price relatively risk-free assets, how do you expect to price risky assets?
Yeah.
And, right now with the next rate being a coin flip, half the people are going to be disappointed one way or the other.
What is the significance, as you mentioned, we're bouncing around, but let's just take the 10-year. I mean, we're below 370 this morning, 368. That's bringing the mortgage rates down closer to 6%. We could maybe even be headed below that territory soon. That clear move tells you what exactly for equities? Is it supportive? Are we back into the kind of bad news risk-off paradigm?
I think we're back to bad news being bad news and good news being good news. The reason for that being that we've priced in rate cuts. The discussion is not whether we're getting rate cuts, it's how much. And so I think, we've kind of hit that paradigm. The idea, though, that rates are coming down a little bit, sometimes that's the question of why. And I think they're coming down now, not for a particularly good reason. It's because we're concerned about the economy. And that's got other ramifications for a stock market, which, by the way, is still pricing in double-digit earnings gains for next year.